What's the number one reason a really promising real estate deal goes bust? It's usually not the market, it's not even the location. It's almost always an invisible financial leak. So today, we're diving into the financial shield that separates the winning investments from the disasters: capital reserves. It might not sound flashy, but trust me, mastering this is absolutely non-negotiable.
So, let's talk about your building's hidden dangers. You might think the brand new building you bought is just perfect, but I'm telling you, think again. Every single commercial property, and I mean every one, has these hidden financial time bombs just ticking away right under the surface, just waiting for the worst possible moment to go off.
All right, here's a good one for you. What could a rickety 20-year-old roof and a brand new money-making tenant possibly have in common? I mean, one sounds like a huge problem, right? The other sounds like a solution. But they're connected by one super critical factor.
And that is, they both cost a ton of money. Think about it. Replacing a roof, that's a massive, predictable expense. But attracting that shiny new tenant also means a huge cash outlay for things like broker commissions and tenant improvements. Both of these are totally unavoidable costs that will absolutely drain your cash flow if you're not ready for them.
Okay, so you're facing these inevitable, giant bills. How do smart investors not just survive, but thrive? Well, they don't just cross their fingers and hope for the best. Nope, they build a powerful defense, what we're calling the investor's financial shield.
This shield has a name. It's called a reserve fund. Now, it's really vital to understand this isn't just your regular bank account for the property. No. It's a dedicated, separate pot of money that's been specifically earmarked for future costs. Everything from that new roof we talked about to surviving an unexpected vacancy.
And I absolutely love this analogy. It's not just a savings account, it's a strategic war chest. It's an offensive and defensive tool. It defends your property's value by making sure you can actually afford repairs, and it protects your financial returns by preventing those surprise cash calls that would otherwise just gobble up all your profits.
But here's the thing. A reserve fund isn't just one giant piggy bank. Not all reserves are created equal. A really strategic plan breaks them down into different categories for very different purposes. Let's look at the anatomy of one.
So basically, reserves break down into four main types. You've got your CapEx for the big replacements, you've got TI and leasing commissions to keep the tenants happy and coming in the door, you've got operating reserves for those uh-oh moments, and deferred maintenance to fix the problems you inherited when you bought the place.
The whole key to CapEx reserves is predictability. These are for the huge ticket items you know will fail eventually. It's not a matter of if, but when. A roof has a 20-year lifespan, give or take. An HVAC system, maybe 15. The pros don't guess. They get detailed engineering reports to predict these costs, and they save for them methodically, month after month.
Now this next category, this one is all about generating revenue. You can't get tenants without paying the brokers their commission. That's the LC. And you definitely can't sign a new tenant without customizing their space. Those are the TIs. This reserve fund is literally the engine that drives your building's occupancy, which of course drives its income.
And this just shows you the insane scale we're talking about. $20 to $60 per square foot. So on a 10,000 square foot space, you could be writing a check for $600,000 just to get a new tenant signed and moved in. We are not talking about pocket change here.
Okay, so we get why we need reserves. That's clear. But how do you actually build these funds up? I mean, where does the money even come from? Let's talk about how the funds work.
Well, there are four really common ways. First, the lender might just force you to put a big chunk of cash aside right at closing. Simple enough. Second, you can make fixed monthly deposits over time, like a savings plan. Third is something called a cash flow sweep, which is kind of cool. Any extra profit gets automatically swept into reserves before investors get paid. And last, there's triggered funding, which only kicks in if something bad happens, like your occupancy drops below a certain point.
And this brings us to this natural point of tension, this tug of war in every single deal. The lender, their number one goal is protecting the building, which is their collateral. So they want massive reserves, a huge cushion. But you, the investor, you want to maximize your returns, which means you want to minimize how much cash is just sitting idly in a bank account. Negotiating this balance is a real art form.
Now for the part you've probably been waiting for, how does all of this actually affect your bottom line? Let's follow the money and see the real impact on the cash that could end up in your pocket.
So let's use an easy example. Let's say your property generates $1 million in net operating income. That's your profit before you pay the mortgage. Okay, so after you pay your $200,000 mortgage, you might think, great, I have $800,000 left. But you don't.
First, you have to subtract that $150,000 deposit into your reserves. The actual cash that's available to distribute to your investors is only $650,000.
And looking at it like this just makes it crystal clear, right? The impact on your take-home cash is huge. You start with this big number, your NOI, but after you pay the bank and fund your reserves, that final number, the distributable cash, is a whole lot smaller. This is where so many deals fall apart. People underestimate that reserve deduction and they overpromise returns.
And believe it or not, there are even more strategic layers here. For instance, you don't get a tax deduction for putting money into reserves. You only get it when the money is actually spent. And when you go to sell the property, that cash balance in the reserve account usually transfers to the new buyer, which can impact your final sale price. Even negotiating who gets to keep the interest earned on that cash is a key deal point.
So this all brings us to the ultimate takeaway here. Understanding and truly mastering reserve management is exactly what gives professional investors their edge.
And this quote from our source material really just says it all, doesn't it? The sophistication of reserve fund management often distinguishes institutional quality operators from less experienced investors. Amateurs guess. They cross their fingers and hope a big expense doesn't hit. Professionals plan for it with incredible precision. And that discipline is what lets them weather any storm and deliver consistent returns year after year. So I'll just leave you with this question to think about. When you're looking at your next investment, are you getting seduced by those flashy, big number income projections? Or are you digging deeper and looking for its financial shield? Because a strategy without a strong reserve plan isn't just optimistic, it's fragile. And the real question is your strategy truly built to last?